Everyone who ever created generational wealth is an investor in the stock market or the financial market. And none of these people have ever invested only in a particular or a single economy. They have diversified their economy. Some are also investing in economy with higher currency and higher stability. So today, we'll be showing you the secret of the world's richest men or African richest men, how they have invested in other economy. So we're talking about 5 US ETFs that you can invest in and also create generational wealth. Now, if you have been an ardent follower of this channel, we've talked about ETFs, that they are one of the ways you can actually get into any market in a safe ride. So we're talking about 5 US ETFs that you can invest in from any part of Africa, from any part of Nigeria, with the same stockbrokers you are using to invest in the Nigerian economy. Welcome to Clockwise. My name is Providence, and my guest is here, the one I tell you every day that he sleeps on the chart and he also looks at the fundamental on a daily basis. Please, with a resounding virtual round of applause, welcome Mr. Kane. Welcome to Clockwise again.
Thank you very much for having me.
It's nice seeing you again today.
Thank you. Thank you.
And today's conversation is something that is of interest, not just to me, but I know you know why. And I think to most of our subscribers or our viewers. So let's just dive in straight to the conversation. Now, if you're somebody that is an added follower of biographies or autobiographies, you will see that one of the world's richest men, or one thing that's synonymous with the world's richest men, is that they have investment in other companies, in other economies, in other countries. They have assets in other countries. And we'll be discussing those assets today. So how do you see that type of investment diversifying to other economies?
Okay, so thank you very much for that. So the fact is that you cannot, as an investor, you cannot afford to sit on just one economy because if anything happens. Let me give you an example to think about. When immediately the US invaded Iran, the Korean stock market crashed very hard. That's because South Korea, for example, does not produce oil. So they import literally every single oil they have. And they import from the Persian Gulf. So you're talking about from Iran, from UAE, the Persian Gulf. So with the Strait of Hormuz blocked, what happened was that the investors predicted that would affect the South Korean economy. And that's why the market crashed. So imagine if you're an investor that invested only in the South in the Korean market, you are going to see a very serious dip in your portfolio. So that is an example of a concrete reason.
Why?
Same thing happened why you should not invest in just one country. And unfortunately, I'm going to also use Nigeria as an example. If you look at in Nigeria 2022, 2023, a lot of the stocks in Nigeria crashed very hard. Some of the stocks that are posting gains of 200, 300, 400%, just didn't come around from very good years. They actually are recovering from a very battered couple of years. So if you are investing in just one economy, you are exposing yourself to a geopolitical risk, a very serious one. A geopolitical risk, you are exposing yourself to the risk of that particular economy going down.
And it's even easier.
Peculiar problems to a
it's
particular
even easier
economy.
to invest in other economy from anywhere now.
Yes.
It's even easier now.
It's easier for you to do now. So we always advise our investors, just like you diversify your portfolio, meaning not investing in just one asset class, you want to also diversify the economies where you invest in. So we have, over the past couple of days, we've talked about Nigeria and how Nigeria has been, how people can invest in the Nigerian economy, buy stocks, the last one was the ETFs in Nigeria. So it's also important that we also talk about other economies and the ETFs.
Let's dive in. Now, if you were to invest in other economy, let's assume you are just new to the investment market, because I know you've been investing in the US market for a very long time. Let's assume you're just hearing this today, and you're just seeing this particular podcast today, and you want to start investing in the US economy. Which of the 5 ETFs will you go for?
Okay, so I'm going to take them. The first one I will be considering would be the an ETF that tracks the NAS 100. That is the top 100 tech companies in the US. One of such is Invesco QQQ. So the ticker symbol is, I like to say this so you can check it out on your chart, is QQQ. It actually tracks the top 100 tech companies. So it's very tech heavy. 100 tech companies in the US. It's been performing well, especially since 2022, 2023. It's been doing very well because of the tech boom, especially fueled by AI and all the innovation. So you see some of the tech names, it's most especially like what we call the Mark 7. The Mark 7, the top tech companies, you're talking about Microsoft, you talk about Amazon, you talk about Nvidia. Those names have actually made that particular index to move very high, and we still expect it this year to move very high. Okay. Already the Nasdaq, that is NAS 100, has hit a new all-time high. And just for context, just a couple of weeks ago, it actually hit the rock bottom. Really, like with the crisis you had in Iran, it actually hit the rock bottom. But I think the lows for the year. The lows are in, so we expect a lot of upside for that. Okay. So the Invesco QQQ is the first one I'll be looking at. It's been performing very well. Like I told you, it's been tracking the land.
At this point, it's actually good to invest in it, to actually buy.
Yes, it's a good time because I still have my year-end target is still not reached yet, if you ask me. And I think we have recovered. It's been like a V-shaped recovery. The Iranian crisis actually took it down. Maybe a good time to have bought would have been a couple of weeks ago. But now it's still a good time. This morning we opened and there was a dip a little bit. So it is still a good time for you to dollar cost average. If the situation in Iran is not entirely settled, then I think we could still have some buying opportunities down the road. But you could start dollar cost averaging because it's better for you to have some exposure at this point than for you to wait until because I think the lows are in. Okay. So you might not be able to catch a lower low than what we have said already.
Okay. Yes. All right.
That's one. The next one, the QQQ. Okay. Yeah. The next one is the Global X Robotics and Artificial Intelligence. The ticker symbol is BOTZ.
BOTZ.
So that actually tracks from what you've heard, the names, robotic names, artificial intelligence, automation, and artificial intelligence. And it actually has been moving very high because, we've seen the numbers that some of these hyperscalers have done. Without sounding very technical, but hyperscalers are those that provide compute capacity for, most especially for AI companies. So whether companies that are linked with AI, companies that are linked with automation, companies that are linked with robotics, they form part of this ETF. So that particular ETF actually tracks the performance of these stocks, and we've seen what Nvidia has done. Nvidia has been screeching, if you ask me, in terms of performance. It's been outperforming. In fact, essentially since 2023, Nvidia has been posting better than expected. It's been beating on top and bottom lines. Okay. And we expect that to continue to grow because demand for compute is still on the high side. Mm-hmm. As a matter of fact, Nvidia is even looking at 3, 4, 5 years demand down the line. Okay. So any ETF that tracks the Nvidia and all those other hyperscalers. Nvidia is not a hyperscaler, by the way, but chip makers and hyperscalers is going to perform very well. So I would also look at investing in this particular
BOTZ.
BOTZ. That's Global X Robotics and Artificial Intelligence.
The third one?
Then the third one, of course, by the way, just so I mentioned, the Nasdaq and the NAS 100, that is QQQ, that tracks the NAS 100, but these are actually very sensitive. What I mean by sensitive is it can fall very hard, because tech stocks are usually driven by Fed policy. I think in the previous video we had gone exhaustively about how they fade. Maybe another video we will talk about how the Fed actually controls the market, because when you talk about the US stock market, you talk about what is happening with the Fed, what is happening in the bond market, which is that in direct correlation with what is happening with the Fed, So you have to be very careful about that. That is why these are growth ETFs. These are growth ETFs. But you want to also balance that out with something more stable, like the S&P 500, whatever tracks the S&P 500. And in this case, we're looking at the SPDR, S&P 500 ETF Trust. Its ticker symbol is SPY. So
that the third one?
That is the third one. SPY. So this is actually an index, like I've already mentioned. It tracks the S&P 500 index. S&P 500 index is actually an index of the top 500 companies in the US. Performing companies. Of course, you can't be top when you are not performing. And the way it works is that frequently the index is revised, meaning that some companies are dropped and some companies are even performing when they are not performing, and some companies are brought in. So you are sure that you are not literally picking names, really. By investing in SPY or S&P 500 SPDR, S&P 500 index, or ETF, you are actually investing across the 500 companies that particular ETF tracks. So just to show you how much it tracks the S&P 500, this index, this particular ETF, in 2023, it did 24%. The S&P 500 did 24%. In 2024, it did 23%. The S&P 500 did 23%. Last year, it did 18%. The S&P 500 did 19%. So you can see that it follows the S&P 500 very closely. Okay. So that is, and I mean, just so you know, these have been very good years for the S&P 500.
Yes, I am.
But over a period of 30 years, the average return on the S&P 500 has been 11%, 11 to 15%. So you might not say, because we did 90% last year. If you look at it, it's been depreciating. So we had 24, 23, 90%. But there's something I want to show to our viewers so that they see. Because sometimes a problem that people have, especially in Nigeria, that's why you had some of these Ponzi schemes succeed so much. Because they tell you we do 20% per month. And so Nigerians fall in, because you want to make 20% per month. But I think this is a show that you are going to learn a lot. S&P 500 returns 11%. And you might think it is small. But the thing is, I've always said, compound interest is the eighth wonder of the world. If you allow compound interest to work for you, you're going to make insane gains. Let us do some numbers. And that's why I brought my my device here. So we can do the calculation together. I think we are going to put up the calculation on the screen so you guys can see. So let us say we're talking about the US now. Let us say you are looking at 15 years. Let's say you are getting married, and then you're gonna have children, and then you are targeting your child's university education. So you are looking at a period of 15 years. The average time a child finishes secondary school and is ready for the university is 15 years. So let's do some numbers here. And let's say you start with as modest as $1,000.
That's with like 1.
That's 1.4 million roughly.
Yeah, over 4 million.
I mean, it might be lower, but I'm just using $1,000 as a baseline. So, by the way, what I'm using here is compound interest calculator. You can see it if you just do a Google search. You will see compound interest calculator. The one that is thecalculatorsite.com is actually the one I'm using. Of course, it will be shown. So, you start with $1,000. Then, like I said, the S&P 500 interest rate, the S&P 500 returns 11%. 11 to 15%. But I'm going to even use a conservative figure, 11%. Which is 11%. So we put in 11% here. Then it's compounded annually. Then compound frequency, I want to put it at yearly. Yearly. How many years are we looking at? Like I said, your child, we are looking at projecting 15 years. That's a challenge where people will say, I want to invest and pull out next year. You have not allowed compound interest to work. But we're going to see just now the magic that happens. So regular contributions we are doing, let's say we are doing $100 every month.
Okay, $100. Let's say $100.
Yes, we're doing $100 every, which is about 140,000. And if you are disciplined enough, the fact is, you always want to pay yourself first. When the money comes, when the salary comes, the first thing, in fact, what I advise my mentees is operate an automatic debit. So once it comes in, it's automatically debited to your investment account. And most of these platforms that we've been talking on this channel, they have the capacity to.
You actually invest lower, but let's assume $100.
But we are just doing $100 for purpose of we don't want the numbers to round figure. Then how much do you deposit? So it's $100 here, $100 monthly
for 15 years.
For 15 years. Don't increase it. We are saying for the entire 15 years, you are most likely, you might increase it over time as you make more money, but let's just assume you don't want to increase it. So now that we have this, so we just do what? Calculate. Remember the parameters we are using. We're starting with $1,000, 11% interest rate, and then for 15 years. We are contributing $100 monthly. Now watch this. In 15 years, total amount that you have, what you started with was $1,000. Over that 15 years, you have actually invested, you have added
$100.
With $100 per month, you have done $18,000. So total invested is $19,000 in that 15 year period. Watch this. Your future investment will be worth $48,152. And that means you have earned $29,152 for doing absolutely nothing.
Just investing.
Just your money. Your money has earned you $29,152.
If the interest rate is not increased.
That is if I'm looking at the base. We are looking at over the base interest. Not interest in this case. The base return on the S&P 500, which is 11%. So you can see that if you invest in the SPY and follow what I'm just telling you, the numbers will come out.
What do you make? You
make $29,152 in 15 years without doing nothing. If you increase instead of $100, it moves that way. If you increase maybe in $2,000, if you do $2,000, the way it works is because it's compound interest, what you make will be more than this $29,000 because of the time factor that compound interest works with. So that is it for SPY. So I just wanted to show you, to demonstrate to you that 11%, you might think 11% is too small, but the reality is 11% is a good...
Now, before we go to the fourth and the fifth one, now let's re-emphasize the safety net of actually investing in ETFs. People don't actually understand why you should invest more in ETF than actually buying stocks.
Okay, good. Just so you know, between 2000 to now, the S&P 500, the US stock market has lost more than 60% of the companies. So 60% of the companies that were present in 2000 are no longer in existence. More than, actually, not even more than. So you know what that means? That means that imagine if you picked a name and that name no longer exists. You are gone. And investment, here is what you should know about investment is not a loan. You cannot go and tell the company, listen, where is my money? No, you can't. You bear the risk and the liability and the profits, of the company. So, but guess what? Within that period and now, the S&P 500 would have given you, you can put in your compound interest calculator and see how much you would have earned if you had simply invested in the S&P 500. That's why Warren Buffett said that the S&P 500, as a matter of fact, a lot of fund managers rarely beat the S&P 500. If you just invest in the S&P 500, it's literally investing in the American economy. And when Warren Buffett was asked, what do you think is the secret of your wealth? He said, one of the things he said is investing in the US, as in being born in the US and investing in the US economy. So you don't want to pick a name. One of the things about picking a name is that you might not be able to tell. It means you have to track. It's like investing in a normal business. You want to follow up, listen to, be on earnings calls, read the papers, documents, like balance sheet, know what the balance sheet and a lot of information about the company on a quarterly basis, so that you know how to make your investment decision. So if you are not in the position, if you are in a business, if you are in a job that doesn't allow you to do this, or you don't have the technical know-how to do this, it's simple to invest in the in ETFs. Okay,
let's go to the fourth.
So the fourth one will be ARK Invest. So ARK Innovation Trust.
What's the ticker symbol?
The ticker symbol is ARKK. ARKK. So that is actually like investing in innovation on steroids, because that particular ETF invests in very disruptive technologies. So that's why you have, it's managed by Cathy Woods, by the way. So that's why you have, they invest in genomics, they invest in robotics, they invest in fintech, disruptive technologies like Tesla. They invest in Tesla. They invest in biotechnology. They also invest in digital assets. For example, they have a good position in Bitcoin. ARK Innovation Trust also invests in. There's this company that I have a good position in. It's called BMNR, Bitmine Emission Technologies. But I'm not making any recommendations here. If you believe in the future of decentralized finance, then you want to look at that. So they invest a lot in that.
So the fifth one. So
before I say, remember, ARK Invest dipped very scandalously in 2022. So ARK Invest is like that's why I said it's an investment, is what you call high risk on steroids. It can go up very high. It can also crash very sharply. But it also improves the Sharpe ratio of your portfolio. That's why you have to use it. You use it to balance, to increase the Sharpe ratio of your portfolio. You cannot afford to go all in, because you might literally see your portfolio dip by more than 40%. So that's it. That is the fourth one. Then the fifth one would be the Vanguard Total Stock Market ETF. From the name, Vanguard Total Stock Market ETF, it invests in the entire US economy. Every single stock in the US stock market. So it's like a broad market index. So what it does is that you are literally investing in the US economy. Yes, so it performs as well as how the US stock market is performing. So this could be like, you could use the VTI, by the way, the ticker symbol is VTI. You could use the VTI and the SPY as what I call the foundation of your portfolio. These guys would help to stabilize your portfolio. Then the other names like the NAS 100, that's the QQQ, as well as the ARK Invest or ARK Innovation Trust could be like those things that would actually help to push the Sharpe
let's go over
ratio of your portfolio. So the list again will be Invesco, QQQ, ticker symbol QQQ. You have the next is the Global X and Artificial Intelligence, BOTZ, investing in the artificial intelligence stocks. You have the ARK Invest. Then you have the SPY, which is the SPDR, S&P 500 Investment Trust. And of course, finally, you have the Vanguard Total Stock Market.
You can invest from Nigeria, right?
Yes, you can invest. All these things.
Any of the brokers?
Yeah, you can use a stockbroker to invest. You can also use investment apps. Investment apps allow you to. One of the reasons why we don't really emphasize so much on stockbrokers, registrars, and all of that is because, the average viewer of this channel is a young person. We want something that is very easy. You go for some of the investment apps
are
registered, especially those ones that are registered. So you will have your CACS number, because it's very important. If you don't have your CACS number, you are not an investor. Nobody knows you, because CACS actually is Central Securities Clearance System. There's a number that identifies you as a stockbroker. You must have that, and then invest. Once you just deposit, you can deposit in Naira, and then you can convert. There's a window that allows you to convert to US dollars, and then when you convert, then you buy. Sometimes a few fees can come in. I think there's a platform that charges 1.4% for you to open your trades, for you to and then when you close your trade, that's when you sell off your position. You also pay something similar.
All right, now we don't want this video to be too long, so that not to follow the end. Let me hear your final word before we actually go.
For a newbie, ETFs are the places for you to. It's for me, it's the place to start. You are not smart, sophisticated enough to be able to pick and choose a name. So what you want to do is to invest in ETFs. That way you are investing in a basket of companies. So you don't have to pick winners and losers, because you might not be able to do that.
All right. Thank you very much for coming. And we are going to continue again in our next episode. Now, on that note, we'll come to the end of today's episode of Clockwise. Now, we've discussed 5 ETFs, US ETFs you can invest in from any part of the world, and also make money in dollar and spend it in naira. My name is Providence, and please do not forget to like, subscribe, and also put on a notification bell on this channel, because we bring amazing content. And please don't forget that investment is a journey, and the compass you need is knowledge and experience. That's why you must always be on this channel, because we do a lot of analysis here. And also you can drop your portfolio arrangement and ask any question on the comment section. We are here 247 to provide answers to those investment questions. And also, finally, do not forget that the elite of the 21st century are not those who did not go to school or those who will not go to school, but are those who have refused to evolve as their environment is evolving. My name is Providence once again. I'll see you again.